Hey everyone, welcome to episode 67 of the Julia LaRoche Show. I am so pleased to bring to you this conversation with Jeff Snider. He is the host of the Eurodollar University podcast. I have to say, I think Jeff is the most requested guest I've received for this show. So thank you to those who suggested him. I do read your comments in the comment section and I love engaging with you all. So again, thank you so much for suggesting Jeff for this episode. Jeff is an expert on the global monetary system, specifically the Eurodollar system, and its misunderstood inner workings and the impacts that it has on global markets, the economy, and commerce. I really enjoyed this conversation with Jeff. I got his take on the global macro economy and the picture there, which is pretty ugly, I have to say. We also talked about markets, and right now markets are screaming bloody murder. I also got Jeff's take on the story around de-dollarization and his thoughts there. And of course, we did a dive into this black hole that's known as the Eurodollar system. And again, some of the impacts that it has. Really, really fascinating discussion there. I learned a lot. It was illuminating, and I think you will too. And by the way, if you're new to the channel, welcome. It's so great to have you. Please be sure to hit that like button, hit the bell so you can subscribe and you won't miss any future episodes. And if you are a returning viewer, thank you so much for your support. It means so much to me. And if you're listening to the show, please be sure to leave a rating and a review so I can continue to bring you more in-depth conversations with some of the most fascinating people. Again, thank you so much for your support, and I hope you enjoyed this episode with Jeff Snider. Jeff Snider, host of the Eurodollar University podcast. It is so great to welcome you on the show. Thank you so much for joining me.
Oh, thank you for having me. I'm really looking forward to it.
Well, I am too. And shout out to some of my viewers, Seth and Andrew being two of them, because you are probably the most requested guest that I've had. In the comment section, folks are constantly asking for you. So I'm so excited to have you on. And also for the folks who are watching and listening, Jeff is one of the foremost experts on the global monetary system, specifically the Eurodollar money system, which we will certainly get into. But where I usually like to start, Jeff, is with the big picture, the big macro view. What is that for you today?
Oh, all sorts of ugly. Yeah. Is there anything good about it, really? No, the macro picture, we start talking about the global economy. I mean, we've been slowing down. I think everybody agrees the global economy slowed down from the artificial rebound in 2021 into 2022. The question on everybody's mind is, what does that actually mean? For most people in the mainstream, certainly policymakers, the idea is that we were red hot inflationary. So rate hikes and everything else, we had to slow the economy down just to get it into a more sustainable and stable position. That's their idea. That's their narrative. And it's never been one that's been shared by any of the markets, even stock markets for that matter. The markets have said that the economy in 2020 and 2021 was an artificial high, and that it was eventually going to revert back to its potential, which probably wasn't very good. And as events unfolded over the last couple of years, but especially the last half of last year, more and more it looked like that's the case. And so we begin this year, though there was, talk of a soft landing or even a no landing in the US or Europe. I think most of that's been put away after the events in the banking system, which is another angle, another part of this systemic reversion, which is it's not just about the macro economy, it's also about the monetary system too. So there was a reckoning coming in the global economy. There's a reckoning, a dollar crunch, a dollar shortage coming in the monetary system. And when you put those two things together, nothing good really ever happens. You've got a weak economy plus a bad monetary system that's creating relatively substantial, sizable events that even the public pays attention to. There's not a lot of good potential there. And of course, after we've gone through everything this month, looking forward into April and beyond, the markets are still saying this wasn't the end of everything. We're still in the beginning stages.
Okay, there's some amazing first answer. There's so many great things, and that's why I'm excited to have you on. So we're still in the early stages. And you describe it nicely that it's really ugly out there. And if we're in the early stages, does that mean it can get even uglier? Like, what is kind of the scenario that you're thinking about, or like the probability of, are we about to enter a recession? Are we in a recession? Like, what do you think?
Well, there's a lot. I mean, recession is it's more of a term of art anyway. There is no technical definition, but I think that the overall point is really what is going to happen to the economy, whether it's called a recession or not. I think in relatively short order, everybody will agree that's the case. Whether we're in one or not, I mean, that's debatable, and to a certain extent, it really doesn't matter. But what we're really looking at is as weak as the economy had been over the last year or so, it's looking much, much worse in the short term and intermediate term outlook. So that means specifically for the US, for example, while some of the employment numbers look really good, we've also gotten a lot of anecdotes as well as some data that suggest already there's some recessionary process, job cuts, hour cuts, things like that going on in the labor market. And if things continue in that direction, along with the rest of the global economy, we won't just see minor adjustments in corporate payrolls. We'll actually start to see the mass layoffs that then become the unmistakable recession characteristics that we're all really kind of looking for. That's sort of the base case here. As frightening as that sounds, something like a serious recession is sort of like maybe the most optimistic outlook, at least according to the markets. So it means a lot more. What we've already experienced to this point, it means a lot of these things are going to get a lot worse relatively shortly ahead.
That's okay. I follow on too, because you're right. Like a lot of times, it seems like people point to strength in the labor market, that unemployment's still really low. What kind of factors could change that for you, or like how do you kind of assess the labor part of the equation?
Well, we get lulled into a false sense of confidence about especially the unemployment rate. Because it sounds like, I mean, if the unemployment rate is really low, as it is now, it's very close to a 50 or 50 plus year low. It sounds like the labor market must be doing really well. And therefore, if the unemployment rate is really low and the labor market's really doing really well, how can we possibly get into a recession? When history has shown in time and example after example after example, usually the unemployment rate is really low just as the recession begins. So the unemployment rate doesn't give you much cyclical comfort or information. In fact, the lowest unemployment rate in the US on record occurred the month before a recession started. So throw out the unemployment rate to begin with. I mean, there's all sorts of problems with that just from the beginning. I mean, it doesn't include the participation problem. So even if you were looking at the unemployment rate from a less fundamental perspective, a more cyclical perspective, it doesn't give you much information. So if anybody like Treasury Secretary Janet Yellen did last month says, we can't have a recession because the unemployment rate's low, she needs to go back and look at economic history, because in the US, Europe, and everywhere else, unemployment at the beginning of a recession, it usually starts out pretty low. So looking past the unemployment rate to some of the other data, I know the payroll reports are all relatively good. They're positive, a couple 100,000 per month. But that too can be misleading. There are several recessions, in particular 1973-74, where payroll reports continued to be modestly positive through half the recession. So my point is that the labor statistics and even some of the labor market characteristics itself, they can be misleading. They're not really good cyclical indicators, which is why you hear people say they're lagging indicators, because really the real part of the recession that we all think about as recession, the mass layoffs, those tend to be backloaded. So we could be in a recession right now and wouldn't see the mass layoffs. Although, I mean, if you've been paying attention, we've been hearing about layoffs since November. So we've already entered that sort of situation. And there's a lot of data, secondary data, like the household survey, for example, that have suggested that we're in at least a pre-recessionary condition and have been for quite a period of time. So it may be we haven't gotten to the worst part where the layoffs really start coming fast and furious, but that doesn't mean that they're not coming because the unemployment rate's low.
Yeah, it's an interesting point too, because you put out a few examples and how like looking at the unemployment that can be misleading. Why do you think people look at or put out that narrative then of, okay, look at the strength here? Or why do you think that is?
Well, because it's, first of all, the economics is it's complicated, it's difficult. And so we're all looking for what are the 2 or 3 things that we can look at to say, this is what the economy is doing. And most people have been led to believe the unemployment rate is it. And you think about, in most situations, that's true, except for these cyclical turns. So if we're in a real legitimate boom and the unemployment rate's low, that seems to be consistent with the overall economic condition. Conversely, if we're in a nasty recession and the unemployment rate's high, it looks like the unemployment rate is providing you with good information. And most of the time it is. That hasn't been necessarily as much true over the last 15 years since the last major recession, where the participation problem, as I mentioned, has become an issue. But really, the unemployment rate's a simple number to understand. It's a very simple concept. So it looks like, hey, if the unemployment rate is low, then it must tell us something important about the economy. And it's like that with a bunch of other things too. GDP is one, even though GDP can be quirky, it can be volatile too. In other words, people look at the stock market. They say, hey, the stock market is the ultimate discounting mechanism. And if stocks are doing relatively well, even if they're down a little bit, then that must tell us something important about the real economy. When those are three things that can steer you wrong, especially during cyclical turns. What you really want to be paying attention to, the markets that I'm talking about, are all these money and bond curves that actually do discount information, that actually do provide not just, when a yield curve inverts, most people, that's the only time they pay attention to it, again, because they're taught about all these other things. But these money curves, they tell us a lot about what the system is actually perceiving and acting on in real time, so that we can be better informed about, okay, if the unemployment rate is this, what does the market think about overall conditions? And does it make sense compared to what the market's doing? And this is one of those times. The market is screaming bloody murder. And if you're forced to choose between the unemployment rate and the bond curve, you take the bond curve 10 out of 10 times.
Got it. I do want to get into those markets. I just want to ask one follow-on question to unemployment, because kind of mentioned there's some signs like that we could even be in a pre-recession. Do you have a base case? And I don't know if this is something you do, like what the unemployment picture could look like in the event that we get into a recession. Do you have like thoughts of like, what are we talking about, like a 2008 style? And then I'm just going to throw it out there too, because this is something that's in the back of my mind. What about like the impact of like technology, like AI on jobs? I don't know if that's something that's even worth talking about at this point, but it's just something I've personally thought about. What do you think?
Well, those are, two separate issues here. The first part of that is, I've been talking about a 2008 style scenario for quite some time, because that's what the markets are telling me. Markets are hedged as if that is sort of the outlook that you should be having. And when I say 2008 style scenario, I don't mean a repeat of 2008. What I mean is that the economy is in rough shape, maybe in a recession or heading to recession already. Then you throw on top of that a deflationary monetary outburst, like we've seen with Silicon Valley Bank. It's not really about Silicon Valley Bank. It's not about Credit Suisse. We've got monetary troubles, a bad economy, and you put those two things together. That's what made the Great Recession so great, for lack of a better term. It was a recession to begin with, and it was then hypercharged by the banking monetary disruption, and that's what made it the worst case. So the markets are kind of telling you that they're worried and hedged for the same situation right now. And so as we ended last year and entered this year, you could say the economy was questionable, it was slowing, it didn't look great. So already we had the bad economy piece, possibility of recession, and then we've had all sorts of symptoms about deflationary money going back to last year. And then, of course, in March, I think everybody finally got a real taste of it, because usually you don't have Silicon Valley Bank or those like Signature, First Republic, Credit Suisse, Deutsche Bank, all these banks, they don't get to the brink of insolvency when things are going really well. So there's the other piece of the 2008 scenario. We've got the monetary dysfunction. We've got an economy that's in questionable shape at best. And those two things are looking like they're closer and closer and closer together, which is, again, what markets have been telling us to expect for a very long way back.
Fascinating. All right. And you pointed out earlier that markets are screaming bloody murder. I would love for you to share, frame up like the parts of the market that you're focused on, and what you're seeing, the signs, the signals that you're seeing in those markets.
Well, the funny thing is, it's everywhere. It's every market you look at. Usually, there's a few outliers where you say, okay, this one says this and this one says that, but no, they're all bad. They're all looking for something that's, something really, I don't want to make too much of it, but it's not looking good in everywhere you look. So I'll just give you one example. I watched the German bond market relatively close because the German bond market is number one. The German economy and the German financial system is a key part of the global system. Germany is a very big export country, and there's a lot of money passing in through and out of the German system. So it's a good one to watch. And Germany normally is very stable, very secure. You don't see, like you see in treasuries and other markets, you don't see that kind of violent swings in market curves. But we did this year, going back to September, all that stuff in September, that wasn't really about the UK, it wasn't really about gilts, it wasn't really about Switzerland. We started to see the German curve invert, which was historic. It had never happened, at least under the Euro era. And so there was a little bit of inversion. And then in November, it just went completely crazy. So now we have what's supposed to be a stable, stoic marketplace. Suddenly it looks a lot like the Treasury market. It's getting massively inverted, and it's only gotten worse as time has progressed. So that's one key indication that said there's really something wrong in the global system here, because here we have what should be a boring market turning completely upside down. And of course, it's been like that in the Treasury market, Eurodollar futures, other bond markets around the world that have been inverted since last year. And as events have unfolded, as things have continued, the inversions have only gotten bigger and bigger and bigger, which is the market saying, first of all, yeah, I told you so. And second of all, there's more of this coming. So by the time we got to last fall, really November and December, markets were screaming, as I said, bloody murder in a way that we haven't seen since late 2007. So last fall, the curves were all saying 2008 style scenario was a relatively good possibility even then. And of course, what's happened this year so far? Exactly that same type of behavior, that same type of stuff. So the markets are uniform in saying they're really hedged for that kind of a possibility.
Again, it's so like fascinating to have you on and explain this too. Maybe it'll be helpful to like how we got here. Was it just like the decade plus of low rates? Because, and I think that one of the reasons I want to talk to you, because I think it would clear things up. There's a lot of misconceptions around money printing. Is it? I mean, I'm totally probably wrong on it. Was it the money printing in the last? Like, how did we get here?
That's a big question that everybody asks, because again, we're taught all the wrong things. We're led to believe that the Federal Reserve is where the money comes from. They print money. QE is money printing. And so that's why in the era of money printing, or the era of QE that goes back to 2009 in the US and really to 2001 in Japan, every time the central bank says I'm doing quantitative easing, you hear it all, that the media goes nuts. Oh, they're pouring trillions of dollars into the economy. They're printing money out of thin air. And it's just not true. That's not where effective money comes from. Bank reserves are what the Fed or any central bank creates. And that's sort of an interbank token with a very narrow use, which is why up until 2020, didn't matter how many QEs were done or how big they got, they never had any impact on inflation or any real economic circumstance or parameter. They just don't work, because the real money comes from the commercial banking sector. That's what Eurodollar University is all about, teaching people where this money actually comes from. It's not from the government. It's not from the Federal Reserve. It's created by this ledger money system where banks actually extend credit or they don't extend credit. And it doesn't matter what central banks do. If a central bank engages in quantitative easing and the commercial bank doesn't do anything in response, then it doesn't really matter. It's all about the commercial banking sector, not the banking sector. So between the 2008 crisis and 2020, commercial banks have been retrenching. They've been cutting back on their balance sheets. They've been cutting back on credit, which is another misconception, because everybody thinks that low rates had stimulated this massive credit bubble, when the statistics prove unequivocally that the growth rate in credit worldwide had been growing at a parabolic rate up until 2007 and then completely flatlined off. So we've been suffering from a lack of credit growth over the last 15 years, not too much. And really, in reality, those low interest rates, the persistently low interest rates that we experienced during that time, were telling us that was the case because, as Milton Friedman said a long time ago, low rates are a sign of tight money, not loose money. Again, we're taught all the wrong things. And you can see this throughout history. Go back to the 1930s, the Great Depression, a period that nobody would associate with inflation. What happened during the Great Depression? Interest rates went down and stayed low. And the reason is because when you're in a deflationary situation, you want to own instruments that are very safe and very liquid. That's what a depression environment would be. And safe and liquid are things like US treasuries and government bonds. So if there is persistent, sustained demand for safe and liquid instruments, that's the market telling you about safety and liquidity. It can't be safe and it can't be liquid if there's hyper demand for those things. So again, we get interest rates all wrong, we get money printing all wrong. And then what changed in 2020, what we're really dealing with now, was the fact that we had the supply shock, the pandemic, all the restrictions on the economy. At the same time, fiscal authorities throughout the world threw a ton of everything at the system just to try to make sure that it didn't completely fall apart. All that did was create these massive distortions in both the monetary system as well as the real economy that led to consumer prices getting out of control. But more than that, a lot of harmful redistribution. So as we get further and further away from those artificial interventions, we're starting to see the real economy reassert itself, which is why we have this 2008 style scenario, which is the bad economy and bad money at the same time.
Okay, so this is so interesting because you're pointing out there are these misconceptions. I personally have the misconceptions. And that's why, again, it's
Everybody
so great to have
does.
you.
It's
I was told you were one of like 5 people who understood this. On one of it was, I think Hugh Hendry gave you a shout out on my podcast a long time ago, and I was like, because I wrote your name down at the time, and he said you were like the one person like understands this. Where did the misconceptions come from? Why are they so pervasive? And what was your own like personal aha moment that there were these misconceptions? Because it sounds like a very difficult thing to understand and grasp.
It is. And it's the entire system is set up for you not to understand the truth. I mean, this is a really complicated topic and story, but it's really the Eurodollar story, which is that back in the 1950s, really before then, but in the 1950s, a lot of technological innovations and evolutions started to really coalesce. Given the problem at the great monetary problem at the time, which was Robert Triffin's paradox, which was a shortage of international monies available for a globalizing world. Essentially, what happened was banks outside the United States began to experiment with new forms of money, things like repo, things like currency swaps, derivatives, which don't really fall into the traditional definitions, but yet they're used every day in real situations as if they're money. So what happened in the 50s and 60s, as banks continued to experiment with these new forms of money, central bankers stopped being able to monitor, regulate, or even just influence the monetary system, so that we ended up with, first of all, the great inflation. Where that came from was this monetary evolution. But second of all, central bankers and economists said, we'll never be able to keep up with all this monetary evolution, so we're not going to even try. So monetary scholarship just completely dried up in every official and academic sense, even though the banks continue to experiment and expand qualitatively as well as quantitatively. So the monetary system went in one direction, and the public was told to think about everything in another direction. And so what the Federal Reserve did in response, along with other central banks, was, well, we can't control the money supply, so how are we going to stay in business? What is it we're going to do? And what they came up with was this interest rate targeting scheme. What they would do was they would move the federal funds target, which isn't even that big of a deal in the monetary system. They would move the interest rate around up or down, and that would signal to the economy or to the banking system what the Fed wanted it to do. In other words, they had no idea what the monetary system was actually undertaking, but they would try to influence the behavior of banks so that the banks would take care of all the details. And part of that meant that when the Fed raised the Fed funds rate, we associate that with tightening, even though that's not how it actually works. So the Fed is signaling that it wants the economy to tighten by raising rates. And over time, that's been absorbed as, oh, when rates go up, that must mean things are tightening. When rates go down, that must mean stimulus, when that's just not the case. I mean, think about 2008, for example. The Fed cut rates rapidly from 5.25% and eventually got down to zero, but they got down to around 2% relatively quickly. That didn't create any stimulus. We still experienced a deflationary episode. Interest rates went down because mostly safety and liquidity were being prioritized. So, I mean, there's a lot more to it, but in general terms, that's basically what's happened. The Fed has gone in one direction, the monetary system has gone in another direction. And unless you have that fundamental understanding, as well as the historical grasp about how it got that way, it's understandable why you would think that low interest rates are stimulus, because that's what you're told time and time again. That's what everybody says. And as we all know, everybody can't be wrong, right?
Let me ask a follow on. Like, if everyone thinks it's that, so low rates, if they view it as stimulus, couldn't that kind of create I'm just thinking out loud, couldn't that like kind of create that reaction in markets to interpret it?
Now okay. You've got it. That's exactly it. That's what policymakers believe will happen. That if everybody believes that low rates are stimulus, they'll act as if it is. And as they act as if it is, it will create the stimulus. But do you see the problem with that? Because if not everybody believes it, it doesn't work. In fact, Haruhiko Kuroda, the governor of the Bank of Japan, said this out loud. He said this in 2015, that monetary policy is like Peter Pan. This is not my words. This is what he said, because he's admitting it. And Peter Pan was, if you believe you can fly, you'll fly. And as soon as you stop believing you can fly, you'll crash. But the problem in the real world is we don't work on fairy tales. The monetary system can't run on this type of rhetoric. It needs to run on actual useful currency, which unfortunately, or fortunately, from depending on your perspective, central banks just don't have. They're limited to this type of psychological manipulation. And see, it didn't take you that long to make that leap, Julia, because you got it right. Like, that's exactly it. If the Fed can make you believe in these things, which everything is structured to make you do. I mean, look at the every time there's an FOMC meeting, what happens? There's now a press conference, and we get all these reporters assembled. There's all the flags and the backdrop, and it has all of the feeling of a religious ritual for that reason, to get us to fall for this belief that the Fed is this almighty, the floating head in the Wizard of Oz with all the flames. That's what it really is about. If you believe in the Fed, the Fed can influence your behavior. The economy will work in the way it's supposed to. And unfortunately, the real world just doesn't work that way.
And is that like the separation, or is that a distinction between, because earlier you said like the real economy is starting to like reassert itself. Is there like a distorted economy because of it, in a real economy? Like, maybe I'm totally off here, but help me understand.
There are distortion effects in specific places. For example, the stock market. The stock market responds really well to quantitative easing, not because the Fed is printing bank reserves and then banks use those bank reserves to buy stocks, because that never happens. You don't see stocks on any bank balance sheet. But there is a very, very serious psychological effect, because as everybody in the financial services industry wants, they want to buy stocks. They want their clients to buy stocks. They want to be able to say to their nervous clients, don't worry, just buy, because the Fed is printing money. And so there is psychological distortions along those lines that lead to some potential possibilities where it causes harmful effects. So the stock market went in one direction after 2008, while the economy went in a completely other direction. And we try to reconcile that as some kind of forward earnings problem. But it is, globally speaking, though, in much broader terms, the Fed's psychological manipulations have very limited effects. And usually they're limited to the short run, because after enough time goes by, we can kind of see the fairy tale. We can see the illusion for what it is. And pretty soon you start to realize that if the Fed is left with nothing more, and it's not just the Fed, it's all the central banks, if they're left with nothing more than this type of psychology, then it changes a whole bunch of stuff. From the perspective of running a bank or running a portfolio, if you realize the Fed is all smoke and mirrors, that means that there's a lot more risks than you thought there were.
Do you think that there will be a point where there's that kind of recognition?
Yeah, I think we're slowly moving in that direction. And the Fed is, all the central banks continue to do QE. I think people have a sense that, it's called quantitative easing, And if you have to do it more than once, if you have to do it 10 or 12 times, then how could it have been quantitative? So already there's questions just for the fact that it has to be repeated. But I think people are starting to catch on. The Fed says, recently, we've got all the tools we need. If there's ever a problem, we can fix it. And then what happens a couple of weeks ago? A bank fails. And what does the Fed do? It comes out on a Sunday night and says, we just had to invent a new tool. And I think enough people are paying attention that, wait a minute, you said that you had all the tools you needed, and now you're having to come up with a new tool. Maybe you didn't have all the tools, or maybe the tools that you have, they don't work in the way that we're led to believe. So I think there's a lot more skepticism about just the Federal Reserve, banking, and money in general, even though I think we still have a long way to go to get people to connect all of these things together. Just again, because of everything is structured to make you believe in one certain way. It's difficult to make that intellectual leap to say, wait a minute, I've been hearing my entire adult life the Federal Reserve is a central bank. It does print money. It's the most powerful government institution on the planet. And you're telling me that the Fed isn't even a central bank. It's nothing more than the Wizard of Oz. It's a very difficult leap to get people to make. And it's going to take a lot of time and a lot of repeated failure like we're seeing in order for that to really start to sink in.
What do you like? What do you think they would say? Like, let's say like Fed Chair Powell listened to my podcast with you and I talk about this. What do you think they would say to like what you're putting out there, what you're discussing?
If you held a gun to his head and made him be honest some way, he would agree. They know what they do. It's a dirty secret that they don't talk about. They don't do money. They do psychological manipulation. In fact, if you read through the academic scholarship, you read through the transcripts, as I've done because I'm a very boring human and I've had too much time on my hands, what you'll see is that they realize the limitations of their monetary. They know the monetary system took a U-turn decades ago. This is not a secret. This is not something that would just be something they were discovering. But think about it from their perspective. If your entire regime is based on getting people to believe you're an all-powerful monetary institution, then you can never admit the truth. Because as soon as you admit the truth, you're admitting that you're not an all-powerful monetary institution. And so like Peter Pan, you can't fly. So everything the Fed does is constructed around maintaining the myth. But if you got Powell in a room and said, do you really do money? Can you define money? He would say, no, we can't. We have no idea what the commercial banking system does. At best, we try to manipulate their behavior. And as I said, if you read between the lines and everything they put out, that's exactly what it comes down to.
Yeah. I want to one day like host an episode just to like, what is money and answering that question? Like, how do you answer that question?
Well, money is essentially a two-step process. It's basically a communication of a demand for payment, then some mechanism to affect the settlement. Right? I say I did some service for you. I communicate to you X. I need you to do something in response to pay me back. Whether that's an exchange of some kind of commodity money, if that's an exchange of some kind of government paper, or in the modern system, there's neither commodity money nor government paper. It's simply a ledger system where we keep a common set of books. I say I need you to pay me back. We write down that you owe me X number of dollars. They're fictional dollars, not real dollars. That works just as much as money as if we had exchanged some kind of physical token. And that's really the hard part, to get people to understand that we have a virtual ledger money system that doesn't use government money, government currency. You hear all the time people talk about how governments have a monopoly over money. That's just not true. The monetary system is kept, these ledgers are kept by the bookkeepers at commercial banks. And so what money is today is what the bank says that you have, or what it says that you owe. Because you have to ask the follow-up question is, what is a bank? Everybody has this idea of a bank as a physical fortress-like building with a vault that's built to store government currency, right? You come in there with some cash and you put it in the vault. There's fractional reserve lending goes on, and that's what a bank is. But that's not true. Banks are nothing more than bookkeepers. There is no physical cash. The system works on this virtual ledger currency. And because of that, when you ask the question, what is money? Unfortunately, it's left up to the banking system.
Yeah, I think folks are starting to realize that with recent events, starting with a Silicon Valley Bank being one of it's not just your money in a vault. Like you might think, I want to hear a bit more on your reaction to the banking crisis. And yeah, I just want to hear more of your thoughts on that.
Well, there's more to it. If this was just about Silicon Valley Bank, which I mean, I think we've all learned by now that Silicon Valley Bank was a poorly run bank. It was run by people who never should have run a bank to begin with. But that's uninteresting. That doesn't produce any kind of systemic response. That wouldn't, because you would look at a bank and say, well, it's understandable why it failed. It was run by a bunch of idiots. That doesn't lead to a systemic effect because most banks aren't run by idiots. In fact, most banks are run by competent people. They may not know everything that they should, but still, Silicon Valley Bank was not was atypical in that respect. But yet we still had this major systemic response. Think about this. We've had bank failures, far more bank failures in the past than we do today. During the S&L crisis in the 1980s and in the early 1990s, more than a third of savings and thrift associations were closed. A third, more than 1,000 banks failed. Yet we remember the 1980s and 90s as being booming time. We don't remember really, I mean, some people might, but the banking crisis that was sort of in the background, but the economy was just fine. The monetary system was just fine, even though we had massive failures all over the place, some big ones too. Now we rarely have any failures, yet it provokes all of these massive systemic responses. Because what's changed between now and then is the condition of the monetary system. Back then, the monetary system was expanding. It was global. It was experimenting with new forms of money. It was robust. Ever since 2007, the monetary system has become incredibly fragile, to the point where we have one stupid bank in California that kickstarts a global spasm, a global bout of volatility. And that's really, I think, what's important about SVB. It's not about SVB. It's that this little thing turned into something much bigger in a relative hurry, because that's telling you something important about the systemic nature of how fragile the monetary system is these days. Because unlike the Federal Reserve, the commercial banking system hasn't really been able to fix the problem, because the problem is the commercial banking system itself.
So do you think that it kind of exposed that fragility? Like, I would love to, like, and I know you mentioned it when you're talking about commercial banking. It's just I'm learning a lot from you, and I apologize if some of my questions are repetitive, but I want to just explore a bit more the fragility of the monetary system, if you don't mind.
No, I think that's really what we should be talking about, because that's the real thing here. That's why markets are still so hedged as bad as they are, is that there's still this systemic thing here. And so that naturally begs the question, what is this systemic thing? And while you can never put your finger on exactly what that is, we do have some idea of some general problems that are plaguing the system. And one of them that goes back to 2007 to begin with is a shortage of good quality collateral. Repo, secured transactions, interbank transactions in the wholesale market, huge dependence upon financial collateral. And unfortunately, the best quality collateral happens to be issued by the mostly by governments. And so you say, well, how can there be a shortfall of collateral? Because governments have gone crazy issuing debt. And that just tells you that there's other forms of lesser quality collateral out there. And so what happens is you have a lot of this lesser quality collateral that gets accepted into the system as decent stuff. This is what really happened in the middle 2000s with subprime mortgages. It wasn't really about subprime mortgages. It was about using subprime mortgage structures as a form of collateral that was accepted way beyond what it should have been. So you have all this junk collateral that enters the system. And then when participants start to realize that it is junk and start to treat it as junk, there isn't enough good quality collateral to make up for that junk that gets thrown out. And so you have this squeeze. You have everybody being herded into a smaller list or smaller pile of collateral that they can use in these wholesale markets, which leads to all of the hallmarks and all of the telltale signs of something like a bank run. Because you look back at the 2008 crisis, it was a bank panic. It was a bank run, but it wasn't the bank run that you would recognize in the form of, say, 1930s or before that. It wasn't the depositors rushing to get cash out of banks, because there's no cash in banks. Instead, it was these these banking participants running to get the best quality collateral because there wasn't enough of it. And we still have that same problem today where junk comes into the system to make up for the shortfall. As it gets rejected, there's just not enough left for the rest of participants. It causes at some points leverage financial players that they can't get their hands on the best quality collateral. They have to fire sale assets. So then asset markets become illiquid, which then causes further knock-on effects where collateral gets reevaluated, dealers cut back on their balance sheets, and it just goes on and on and on. And that's, I think, what's going on in the last couple, really going back to last year, that you look at specifically Silicon Valley Bank. Silicon Valley Bank really should never have been insolvent. In fact, it never should have been pushed to the point where it had to sell all those treasuries. I know most people have the idea that SVB failed because it had these paper losses in these treasuries and mortgage bonds. That's not really the case. As it was with Bear Stearns or Lehman Brothers, what really is the systemic issue here is why Silicon Valley Bank was forced to sell those assets in the first place. Just like all those banks 15 years ago were forced to sell the toxic waste of subprime mortgages. It's not the subprime mortgages, not the US Treasuries. It's why they're forced to sell. Because as deposits were drained from Silicon Valley Bank, it should have been able to go into its bank book and say, I'm going to borrow in wholesale markets what I need to make up for the deposit outflows. There are different liquidity buckets that it could tap in order to replace lost deposits. No matter how big the deposit loss is, if you've got collateral, you can go into the marketplace and replace it with wholesale loans. So why didn't that happen with Silicon Valley Bank? Why didn't it happen with Credit Suisse? And the answer likely is that there was something about SVB's collateral that the market was increasingly looking to reject. If I was running Silicon Valley Bank and I was in that situation, I would contact JP Morgan or Goldman Sachs and say, I'm going to put together a pool of my loans that are the illiquid loans that are in my book. I'm going to swap those for US Treasuries that JP Morgan will borrow from an insurance company. I'll go in the repo market and then I'll get all the cash I need to tide me over until this depositor run runs its course. That didn't happen. Didn't happen at Credit Suisse either. So there's something preventing banks from accessing what should be alternative forms of wholesale funding. And I think it has a lot to do with a collateral shortfall, as well as some other issues like that. And that's been, again, a major problem that the system has been operating with from August 9th of 2007 ever since.
Wow. And like, what would be good collateral to have, and what is that shortage in the good collateral? And like, I mean, I don't know if there's an answer to like what the junk or the bad collateral is, but maybe like if you have insight there, like what is the good collateral? It sounds like there's a shortage of it.
The good quality collateral, the most pristine collateral are US Treasury bills. So Treasury bills themselves are they're their own form of currency. Rather than debt instruments, you can tell they're a form of currency because the price of that currency goes way up when there's a shortage. Right now, for example, if you look at Treasury bill yields, they're well below where they should be. They're well below alternatives. Right now, the Federal Reserve is paying 4.8% for something it calls the reverse repo program. That means if you have spare cash and you don't know what to do with that cash, you can go to the Fed and get 4.8% collateralized. So there's absolutely no risk. And so you think to yourself, if I can get 4.8% from the Fed with no risk, why would you ever accept less? Yet what you see often, especially over the last couple of weeks, is at times Treasury bill yields are way, way, way below that. And so you ask yourself, why would you buy a Treasury bill that yields, say, 4% when you can get 4.8 from the Fed? That's a huge spread. And the only answer is that there's a utility for owning the Treasury bill that has nothing to do with the investment characteristics. And that's what gets us into collateral. So these Treasury bills are the best quality collateral. And so what we can infer from that situation, if the prices are through the roof, that must mean there is a shortage of collateral. Now, getting back to your original point, where does that shortage come from? Where is all this junk coming from? And the junk comes from just the natural business cycle behavior of market participants. When things are going well, like they were in 2021, you think, well, this bond that I'm going to be using as collateral, it's issued by some lower quality company, But the economy seems generally fine. There's no real credit risk today, so I'll give you favorable terms for this junk debt. But then the economy turns out to be less fine, and you look at this junk bond and you say, well, I was willing to accept it on these terms yesterday when the economy seemed fine. I'm not willing to do that today. And so I'm going to mark down the value of that collateral, which forces you to either raise more collateral or sell that asset to get rid of it because you can't fund it anymore. And so it creates all of these knock-on effects where, as we start to look at the junk quality collateral differently, it leads to this shortage, which makes people want the best quality collateral back. Not just want, they need the best quality collateral to continue to run their funding. And that's what happened. The junk gets thrown out. Everybody herds into the best quality stuff. And we see these extreme collateral shortages and even collateral runs, most prominently when Treasury bill yields go down, which means their prices have gone through the roof. We saw a couple really, really historic examples of that just recently. March 15th, the 4-week Treasury bill yield fell by 60 basis points. It was already well below the RRP, fell another 60 basis points in the middle of the day, which told you that there was a massive collateral run on March 15th, which means that there's liquidity, money, deflation, all that stuff is going on under the surface. And the only reason we know about it is because it happened to catch a couple of banks that we can see.
Yeah. I want to bring up another topic with you that's very timely, because there are a lot of stories right now about the US dollar, specifically the theme of de-dollarization. And as someone who's an expert in this domain, what do you make of it? And yeah, I just would love to hear your thoughts.
Well, if we have misconceptions about money, you guarantee you're going to have misconceptions about the dollar as a global reserve currency. And I think, again, economics and the media and the mainstream has done such a poor job of educating people. Most people don't even know what a reserve currency actually does and what it's supposed to do or how it does it. And so, yes, there's constant stories about de-dollarization. China, Russia, Iran, Saudi Arabia, they're going to get together and replace the dollar. But we've been hearing that for 15 years because they can't replace the dollar. And it's not really, the dollar isn't really the global reserve currency, the Eurodollar is. And what a global reserve currency actually does is intermediate between various places. So if you're in one place around the world, say South Africa, and you want to buy some material from someplace else, say in South America, you have your own local currency that's not going to be usable in this other place in South America. You have to have a currency available in between that you can both accept and intermediate through. That's what the US dollar denomination does. But the Eurodollar system is what actually makes it viable. Because what the Eurodollar system does is it means that I can take a little piece of plastic in my pocket, travel all the way around the world, almost doesn't matter where I go, and stick that into a computer, and I'll get goods and services. There's this whole massive infrastructure behind it that says we're going to allow money to be translated from different currency forms through this Eurodollar system so that basically anybody can access it anywhere. And there will always be enough currency, or there will always be just enough currency that this massive worldwide monetary system and global economy can operate in the most efficient monetary capacity. So that means that whatever the reserve currency is, it has to be widely available in as many places as possible, and it has to be acceptable in all those places. Those are two non-negotiable characteristics that China's yuan or any other national currency will never be able to meet. And what China and Russia and other people are doing is that since over the last 15 years, the Eurodollar system hasn't been providing enough currency for the Eurodollar global reserve to operate at full capacity, they've been trying to navigate their way around this global dollar shortage, this repeated dollar shortage, by doing what's natural and prudent. So you start trading in your own currency where possible. So you sign bilateral agreements with certain places where you can cut down on your dollar need. You don't need the dollars to intermediate between yourself and, say, Saudi Arabia. So we'll just do some bilateral trade in our own currency. That way we won't need to acquire dollars that are increasingly hard and expensive to get. That's what's really going on here. They're not trying to replace the dollar. They're trying to operate in a dollar insufficiency environment. And they're doing it in basically the fashion that anybody would.
you don't buy the narrative that like the US dollar's dominance or status as a global reserve, or that its hegemony is, there's eventually going to be a reckoning or a day where it's no longer the global reserve. Because I feel like there's been a lot of writing on this too that's been put out there.
Yeah, you hear it all the time. Things like the petrodollar, which the petrodollar doesn't exist. It's people who don't understand the reserve currency and what it actually is. Now, I think the Eurodollar system is being replaced, and it will be replaced at some point because it needs to be replaced. But it's not going to happen all at once. There won't be a day where you wake up and say the US dollar goes to zero. And usually the people who are selling you this narrative are people who are telling you the dollar is going to zero. And oh, by the way, I've got some insurance I can sell you for it. So the idea that the dollar is just going to one day be worthless, that's a narrative that's been invented by certain people to advance a agenda. What I believe will happen is that the Eurodollar will be replaced in the same way the Eurodollar replaced the past global currency, which is slowly over time, a little bit here and there. By the time it actually happens, we won't even notice it. So there won't be, the dollar isn't going to go to zero. In fact, the dollar goes the other way all the time because there aren't enough dollars out there. Demand for dollars continues to be high. It's the supply of dollars that's the real issue here. And that's what's driving all of these alternatives, including cryptocurrencies and digital currencies. Yeah. Because there is inelasticity in the Eurodollar system, there is a need for other currencies to fill in that void. And that's what they're doing. That's what the Chinese are really doing. They're not trying to replace the Eurodollar. They're trying to just get along inside this reserve currency system that doesn't work the way it should.
It's interesting too, like when you point out like there's a shortage of dollars, and I'm just trying to piece it together, but a lot of, like as you're pointing out earlier, when there's this idea, this misconception around money printing, I guess turn on the money printer and like wash the system with a bunch of dollars, but there's a shortage of dollars, as you point out. Where's there that disconnect? Or that's interesting to me too, because like it's not something you would expect. You would think, oh, there should be a lot of dollars.
Yeah, and again, that goes back to what the Fed does. The Fed tries to get you to believe that's the case. And really, it's understandable why people believe this, because you can see what the Fed does. And if you believe the Fed prints money and you all of a sudden see its balance sheet explode by several trillion, you're naturally believing the Fed says it has a money printer. Everybody says it has a money printer. And suddenly there's now 3 trillion in new assets and bank reserve liabilities. We must have 3 trillion more dollars out there in the system than we did yesterday. But it's what you don't see that actually matters. So you see the Fed's balance sheet go way up, but you got to stop and think about, why is the Fed's balance sheet going way up? What is that in response to? What it's in response to is what we can see. Well, there's usually some form of crisis, and it's usually a liquidity crisis. That's a term that gets thrown around all the time. So the Fed is responding to a liquidity crisis by increasing its balance sheet. But what is that liquidity crisis? Where does that come from? What does that actually look like? That's the stuff that we can't see. Because as I said, we operate on an international commercial bank-based ledger money system. It's why I call it shadow money. You can't see that money. We have no idea how big it is. We have no idea really what's going on at any given time. We have very small windows into its operation at times, but honestly, we have no idea how big the Eurodollar system is. But what we can reasonably assume is that when the Fed is expanding its balance sheet in response to a liquidity crisis, that liquidity crisis is coming from lack of money or money destruction in the shadow money system that we can't see. And it must be pretty severe because it's causing the Fed to react to it. So we see the Fed's balance sheet go way up, but we don't see the money destruction that happens in the shadow money system. That's why people are confused, because they see the Fed printing money, or what they think the Fed is printing money. They have no idea the money destruction that took place over here that caused the Fed to react in the first place.
Wow. Okay. So it's kind of like, it's like shadow money, as you point out. It sounds a little bit to me like it's a little bit of like a black hole, because
that's why our logo is a black hole.
I'm not embarrassed to admit this, but like I had never really, until I started doing this podcast and people started talking about it. And I am not an expert by any means. I talk to experts like yourself, but you're helping me have a deeper understanding. And I know you're helping my audience too. Why don't we why isn't there more focus on this or more knowledge on this? Because you don't see this on like mainstream financial television by any means. Like this help me understand like the importance too, because I think you too, like, sorry to just like have this not even good at forming a question here, but it seems like a really important mechanism too for liquidity as well. Just help me understand like why don't we talk about it more and just the importance of this this system.
I mean, a lot of ways it's comforting to believe that there's this guy who works at the government agency who can just fix all our problems at the push of a button. We want to believe that. We want to believe the Fed is an all-powerful institution that knows what it's doing, because believing that allows us to get on with our lives and do everything else, so we don't have to worry about money and markets all the time. So there's this inherent human need to create a sort of money god where one does not exist. I mean, Julia, you hit the nail right on the head there. I used the logo of the Eurodollar University logo is a black hole, because you can't.
That's okay. I didn't even realize that's what your logo was.
Yeah,
Sorry, now I get it. Okay.
You can't see into the monetary system because it is a black hole. But we know it's there because of all the effects it has on everything around it. And so when you start analyzing, say, how the planets move in certain, or how the stars move in certain orbits, you come to the inescapable conclusion that it moved this way because something happened in the black hole that caused it to. And so that's really what we're left doing. And because that's an incredibly complicated and painstaking process, it's one that most people are going to say, I don't want to do that. I don't have time to study money and black holes and what are Eurodollar futures and derivatives and all these things that we can analyze. They don't want to do that because it's so difficult. And plus, you want to believe in the Fed. You want to believe that the mainstream narrative is what it is. And so there's all sorts of disincentives to understanding the way things actually work. But when you start to look at these things, what you find is that these are inescapable conclusions. The orbit of the stars is only because of the black hole that we can't see, that it's at its center. And it's a lot to ask people to do on their own, especially when everything is set up that you don't do that. Again, going back to the Peter Pan analogy. If the Federal Reserve admitted to the black hole, it's out of business. It has no hope of doing anything. If you realize that the monetary system is exogenous to what the Fed has set up, the next step is, what do we need the Fed for? And that's not what bureaucracies do. And so it's set up this entire thing, this whole ritual, quasi religion, which the financial media is very much a part of. And it just reinforces the notion, look at the Fed's balance sheet. Don't pay attention to anything else. I mean, you've heard the term, don't fight the Fed. That's not real. That's a myth. That's part of this legend. These markets fight the Fed all the time.
Yeah. I want to also ask you, because we only have a few more minutes. You did bring up briefly digital currencies, Bitcoin. What are your views on cryptocurrencies, maybe specifically Bitcoin? Do you like them? What are your thoughts?
I like them so much. I work with a couple of them.
Okay, well, let's talk about it.
Digital currency. Look, when you realize that this Eurodollar system that has existed for decades is actually nothing more than a distributed ledger system, making the leap to a centralized or decentralized ledger system and like blockchain isn't really that difficult. We've been on a virtual currency standard for a very long time, just people don't understand and don't realize it. So to me, it's not that big of a difference to go to something like a private blockchain-based system. So I'm a big proponent of digital currencies. I think in the long run, they will win out, but that's long run. That's not tomorrow. That's not next year. That might be next decade type of stuff. And so what has happened is a lot of people have gotten the wrong idea about the Fed and money printing and everything else. And so they pile into things like Bitcoin because they've been told the US dollar is going to be destroyed and go to zero. Then they come to find out the US dollar is not going to be destroyed. It's not going to go to zero. And they pile out of these digital currencies and they plummet. So you have things like Bitcoin and other crypto that are incredibly volatile. They experience these bubbles in the short run, which is actually contrary and counter to their long run potential. We don't need to replace the dollar because it's going to zero. We need to replace the dollar in the long run with an elastic currency that can perform all the functions that it does. And so I believe that in the long run, given enough time some digital currency will be able to do that, or several digital currencies might be able to do that. But that's nowhere near where we are today. So long run, very positive. Short run, I wouldn't go near most of them.
Do you buy, or what are your thoughts on central bank digital currencies? Do you think that we will see that?
We'll see them, but they're not real digital currencies, and they're not likely to do much. Central banks are not taking digital currencies very seriously. You have to understand that it requires an enormous amount of technical competence, an enormous amount of investment in intellectual resources that they're not even coming close. They're not taking it seriously. I talk to people that work in these fields, that work in actually central banks, and no, they're not taking them seriously. What's happening with CBDCs is that they're seeing the private market, the private digital currency developments eat their lunch. They're way ahead. And every time that governments try to stomp them out and strangle them in the crib, they just continue to proliferate. And so as these private crypto projects proliferate, the authorities have to say, well, we're working on ours too, just to get people to stop asking so many questions. But they're not seriously working on any crypto or any real digital currency that would rival anything that's actually out there today, let alone something down the road. I mean, some of the pilot projects have just gone just incredible comical failures. Even the Chinese, their digital currency project, if you talk to people who are honest about it, say it has not gone well. The Eastern Caribbean central banks, one that they launched last year, it was the currency they launched and it was offline for like 2 months. They're not taking these things seriously. They're not investing in any way that they would need to make them legitimate digital currencies. But yet you hear them all the time as these are some kind of boogeyman that's gonna overnight replace everything.
So I used to ask this question at the end of interviews, and maybe I'll start to bring it back. But my final question for you: what is keeping you up at night, or what is the thing that's keeping you up at night that you keep on thinking about?
It's always, what is the marketplace? Again, the black hole analogy, because we can't observe it directly, we're only reverse engineering the effects it has on various markets. It's always what is going on in the black hole that I can't see in the motion of every other thing. Because there's always, the system is constantly changing. You think you got it clocked, you think you got it down, you got all these markets are telling you enough information, and then something will happen that you didn't anticipate that will just completely change the way you look at things. The system today is nothing like it was 15 years ago. So if we're looking at a 2008 repeat, that's you're gonna be looking in the wrong place. It's the modes of failure might be familiar, but the actual method will be something different. And so you always wonder, is there something lurking in that black hole? Is there something in these monetary shadows we don't have a really good enough understanding on that could be surprising us, but that the markets are telling us this is something we're worried about? Does the system say, there's something else out there that you're not seeing? That's what keeps me up.
Yeah. Well, Jeff, I really enjoyed having you on. So I do want to give you the last couple minutes. Let folks know where maybe they can follow you on social media, listen to your podcast, watch your YouTube channel, or read more of your content, and any parting thoughts, anything that we did not bring up in this discussion that you'd like to share. Please take the next few minutes to do so.
Yeah, there's so much more to this. I mean, I wish we had time to really dive deep. And this is an incredibly complicated topic. The Eurodollar, as I said, goes way back when. There's so many misconceptions about money, history, banking, all that stuff. It's just there's a lot to dive into there. And again, I'm sympathetic because most people, you can't expect them to know these things because there's no way for them to know these things. And as I said, everything is set up that you don't know these things. Everything is set up so that you don't ask questions. So really what I tell people is, first of all, don't take my word for it. If you do your own research, which I encourage you to do, always be skeptical about what everybody's saying and do your own research. But if you are willing to take my word for it, you can find me at Eurodollar University. That's the YouTube channel. That's also my website, which is eurodollar.university. I write a column at Real Clear Markets, but most of the stuff that I write nowadays that doesn't go on to the YouTube show, I've got research subscriptions, all that kind of stuff that's available, information at the website. But if you look for the black hole, the black hole that says Eurodollar on it, you're gonna find me.
Well, Jeff Snider, thank you so much for being so generous with your time and your ideas, and also just helping us all learn more. I really, really appreciate you taking the time to be here. Thank you so much.
I appreciate it. Thank you for the invitation, Julie. I do appreciate it.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.